Hello, everyone. My name's Zach Gast. I'm the Global Head of Research and Analytics with CFRA. I'd like to welcome you to this webinar where we're going to cover our biggest concerns performance for 2018 and also what you need to know for 2019. Two birds with one stone. Before we get started, I wanted to remind everyone that today's session is being recorded and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we'll do our very best to answer as many of those questions as we can. So on today's agenda, we will be covering both the performance of companies globally that have been flagged on our biggest concerns list, and my colleague Jen Dang will discuss some of the individual companies that drove, Jen Dang will be covering the what you need to know for 2019. I'll also be covering some of the drivers of our biggest concerns performance. At the end, we'll have some space for Q&A. We also have some analysts available to answer additional questions that may come up on some of the other issues. So talking a little bit about CFRA, for those of you who may not be familiar, just a reminder of what we do every day. The firm as a whole is focused on actionable and differentiated research that allows investors to make better investment and business decisions. Our forensic accounting research seeks to identify companies with a mismatch between market perception and the underlying economic reality for those companies. Finally, our coverage research spans asset classes and delivers an unmatched suite of independent research solutions. Since the focus today is on our forensic research work, I'd be remiss in not noting some of the many ways we work with clients. First, we publish individual company research on approximately 250 companies each year, designed to deliver primarily alpha for our clients. Our Legal Edge team does the same, generating ideas based on legal analysis where they're trying to find asymmetric risk patterns. We'll also have a bespoke and advisory business that addresses the companies you care most about through custom work if we don't cover those through our proactive research. And finally, we do industry and educational reports covering all 11 sectors each year. One of those, and probably the most popular, is our what you need to know for each year, and that's one of the things we'll be covering today. So let's get started with our 2018 performance review. I captioned this strong performance in a difficult year. I think most investors agree it was a pretty difficult market environment due to the volatility. If we were to describe the year, I would say the first half was characterized by a rally that was at times valuation independent. And then in the back half of the year, we got a more general decline as concerns began to surface about the general interest rate environment, economic growth, and some of the trade issues that came forth. From more of a forensic accounting perspective, it was actually a very difficult year. And the catalyst for that was the new revenue recognition rules, which made analysis much more difficult. There were a lot of reasons for that, but if we were to sum them up quickly, the problem was we generally saw income statements being restated at companies for ASC 606 and the IFRS equivalent. But unfortunately, we didn't see the same happen in balance sheets. And when one of your major points of focus is finding mismatches between what's going on in the income statement and the balance sheet, having income statements and balance sheets that don't match is a problem. That being said, that wasn't the only issue. We also saw a continued downward trend in trading volumes across companies. One of our key parameters is looking for companies that trade sufficiently and knowing that our clients would be interested in them. So when market volumes tend to concentrate, that makes our jobs a little bit more difficult. So from there, we'll launch into the actual performance. North America had an up and down year, is what I would say, but ended very strong to finish with positive alpha. So our North American biggest concerns list returned negative 13.9%. That allowed for excess returns of 5.4%. Each year, we like to remind people we are looking for underperformance on our BC list, so that's what we characterize as excess returns, because we're trying to find companies where the market has missed risks through that. Getting to some of the individual companies on the next slide that drove that performance. Triumph Group starts that list with a 48.9% excess return in 2018. Through the end of 2018, it had returned 113% since inception. They've had a rally a little bit this year. But this is our longest running, biggest concerns name. It began with concerns around non-cash earnings that created a material disconnect that we thought would be difficult to repeat. That basic thesis rolled through, and our continued concerns in 2018 were actually around the cash flow levels themselves and whether those were sustainable. We also wrote on Belden, which was able to generate a 33.7% excess return. Concerns there were around revenue that was recognized early due to a technical accounting issue. And we thought the transparency around that wasn't where it needed to be. Finally, GCP Technologies was the third best performer in North America. What we saw there was a spike in accounts receivable that suggested a revenue pull forward. And as we proceeded through the year, that actually came to fruition. When we look at where we had detractors from performance, one of the things we try to do in our performance review is highlight both ends to show you all the drivers of the performance. Our two worst performers during the year in North America were Inogen with a negative 51.3% excess return and Omnicell with negative 45.1%. If we turn to Europe, this was our top performing region for the second year in a row, actually with phenomenal performance. We were very happy with what we saw. The biggest concerns list was down 27.4% during the year. That allowed for 16% excess returns as the European market was down slightly more than the US market. Some of the key drivers there, first we had Koenig & Bauer, which was a company that we added on receivables concerns. Next up was Dur, which had a negative 34.5% excess return, followed by Electrolux at negative 27.8%. Our performance detractors in Europe, I would highlight that we actually had very few companies with negative excess returns. It's one of the biggest drivers of the good performance there was we had a number of names that performed well, but we had very few names that did not perform well. And if they did, they were mostly slightly negative. But the two we would highlight were Orpea, which is a healthcare company that provides healthcare housing, essentially, and facilities. They had a negative 18.4% excess return before we removed them. Edenred was another company where we had identified an increase in receivables and were concerned about a revenue pull forward, but the company was able to meet revenue expectations and we had a negative 16.7% excess return there. Asia performance overall, our BC list was down 15.5% during the year. With the general decline in the Asian market, that actually translated into a negative 1.7% excess return. This is the second year of negative excess returns for us in Asia. We are very hopeful that in 2019 we'll be able to reverse that, and we've already seen some increases in production and that we hope will contribute to that increased performance. If we look at the individual drivers of our performance there, the first is an Australian bank, Bendigo and Adelaide. The concerns there centered around a number of things, credit loss reserves, and also importantly, some very volatile items in the income statement, primarily related to housing price increase estimates. We thought those were going to be difficult to maintain, and the catalyst for that stock's performance during the year was actually the removal of that item from the company's adjusted figures, which the market took as a very negative signal and sent the stock down, capturing about 10.8% excess return. Domino's Pizza was one we added later in the year in December, but still managed to generate 9.5% excess return. We'd identified issues there around same-store sales and some deteriorating franchise economics. The catalyst for the outperformance for that one was there was actually a lawsuit filed a couple weeks after we came out on the name from one of the major franchisees suing Domino's Pizza Enterprises for the very issues we identified. Finally, Samsonite International is a name we added on inventory concerns. We were able to generate an 8.2% excess return on that one. as those came through and pressured margins. In terms of detractors, the two largest names in that department were Lenovo, which worked well in the first half of the year. It's been on the biggest concerns list for a while now, but in the back half rallied sharply, generating a negative 44.4% excess return. And finally, Technology One was one we added in the back half of the year, but generated a negative 26.4% excess return, as that one has not played out yet. So with that, I'd like to now introduce my colleague, Jen Dang, who will provide an overview of what you need to know for 2019. By way of background, Jen joined CFRA as a senior analyst in 2007. She's responsible for global client projects, thematic research, and technical advisory. She came to CFRA with 8 years of experience as the U.S. accounting expert at UBS Equity Research, advising internal and external clients on financial reporting issues and equity analysis. Jen continues to co-chair the U.S. chapter of the Corporate Reporting Users Forum and is a graduate of Beijing University, Columbia University, and NYU. So with that, I will turn it over to Jen.
Thank you, Zach. We are going to highlight 3 accounting issues for 2019. The first is the new lease accounting guidance. For anyone with a global investment mandate, you may have to get familiar with 2 different lease standards, ASC 842 for US GAAP and IFRS 16. The second issue is the new revenue guidance, which became effective last year for most companies. The implications for year 2 are as important as year 1 for companies that had material adoption impact. Thirdly, the FASB's new model for credit impairment. I'll start with the new lease guidance for US GAAP. The new rule became effective in January for calendar year companies. So what are the main changes from the previous guidance? The most noticeable change is going to be lessee's balance sheet. Lessees will now have to put essentially all leases on the balance sheet as right-of-use assets with corresponding lease liabilities. The amount is the present value of the lease payments. The only exception to this requirement is short-term leases. Short-term is defined as a lease term of 12 months or less at the lease commencement date. As far as lease classification is concerned, which was an extremely important issue under the previous guidance because classification determined whether a lease is on or off balance sheet for lessee. The new guidance carries over essentially the same lease categories under the previous guidance. That is, lessees will distinguish between finance leases and operating leases. Lessors will continue to have sales type, direct financing, and operating leases. The new classification criteria are, broadly speaking, similar but definitely not identical to the previous criteria. Under the new regime, classification will remain an important accounting decision, but the focus is less about whether the lease is on or off balance sheet. Classification will impact earnings and cash flows. More specifically, on the income statement, for finance leases, lessees are required to recognize amortization expense associated with ROU assets, which is typically straight line, and recognize interest expense on lease liabilities separately, which is front-loaded. For operating leases, lessees are required to recognize a single lease cost, generally on a straight line basis. The total lease expense still consists of amortization and interest, but they are not presented separately. For cash flow purposes, lessees will continue to present operating lease payments in operating cash flows. And for finance leases, lessees will continue to present the principal portion of lease payments in financing cash flows and the interest portion in operating cash flows. So far, we've focused on lessees because the primary objective of the new guidance is to eliminate the off-balance sheet treatment operating leases for lessees. However, there will be changes to lessor accounting as well, primarily in areas where lease accounting meets revenue recognition, because the FASB views leasing as a revenue activity for lessors. One of the most important concepts in the new revenue guidance is transfer of control. The same concept is now going to determine whether a sale has occurred in leasing transactions. If a sale has occurred, the lessor removes the asset from the balance sheet and recognizes selling profit when control of the underlying asset transfers to the lessee. Another example of alignment with the revenue recognition guidance is costs eligible for capitalization. Under the new guidance, capitalizable costs are more restricted. They have to be the incremental costs that would not have been incurred if the lease had not been obtained. An example of such costs is sales commissions. A few examples of costs that are currently capitalized but will not be eligible for capitalization are allocated overhead costs or costs related to legal or tax advice incurred in negotiating a lease. One type of leasing arrangements that will be accounted for substantially differently is sale leaseback transactions. I will mention two aspects that are tied to revenue recognition. The first is the leaseback portion of the transaction. Under the previous guidance, the leaseback can be either a capital lease or an operating lease. Under the new guidance, the leaseback cannot be a finance lease because a finance lease implies that control of the underlying asset remains with the seller lessee and has not been transferred to the buyer lessor, and therefore no sale has occurred. The second aspect is the sale portion. Both the seller lessee and the buyer lessor will apply the revenue guidance to determine if a sale has occurred. And if a sale has occurred in market terms, the lessee will recognize the gain upfront when the transfer of control occurs. Under legacy GAAP, gains are typically recognized over the lease term. Moving on to IFRS 16. The effective date is also January 2019 for calendar year companies. There are important differences between the US GAAP guidance and IFRS 16. For example, under IFRS 16, lessees will not have operating leases, and lessors will not distinguish between sales type and direct financing leases. But like US GAAP, lessees must recognize essentially all leases on the balance sheet, except low value or short-term leases. As a result, previous rent expenses will be replaced by depreciation and interest expenses. We therefore expect to see improved EBITDA and EBIT for companies with material operating leases. Cash flow from operating activities will also improve because the entire amount of lease payments, or at least the principal portion, will be presented in financing cash flows. The interest portion may be in either financing or operating cash flows, depending on the company's accounting policy choice. Under the previous guidance, payments for operating leases are generally presented as operating cash outflows. We analyzed the impact of IFRS 16 for a group of early adopters. To summarize our findings, we saw material improvement in operating cash flows and boost to year-over-year growth rate in operating cash flows, and also improvement in EBITDA and EBITDA margins. Even though adoption of IFRS 16 added a material amount of liability on the balance sheet, the implication for net debt varies because there is diversity in how lease liabilities are treated in net debt calculations. Many companies exclude these liabilities from net debt. Some present two net debt metrics, one with and the other without lease liabilities. In some cases, there's even an improvement in net debt under IFRS 16. How is that possible? In the cases we came across, previous finance leases were included in net debt, but now all these liabilities are excluded. I wanted to point out that the adoption benefit, especially the benefit to growth rates, may not be apparent, as over 50% of the companies we analyzed did not restate the prior period financial statements, which is permitted. Revenue recognition. This was a top accounting issue in 2018. It should remain an area of focus this year because in situations where the adoption boosted revenue growth and margin growth, the risk of underperformance relative to expectations may be elevated. And this is particularly true if the benefit was not well disclosed. CFRA has put out a number of reports highlighting companies that are at risk in 2019. On the positive side, we expect some improvement in comparability in year 2, especially performance metrics that are partially based on the balance sheet, such as receivables and deferred revenue measured in days sales. As Zach mentioned, in most cases, companies did not restate the balance sheet for the year-ago quarter in accordance with the new guidance. Looking ahead, U.S. companies will have to adopt the new credit loss model in 2020. Early adoption is permitted. I am going to ask our financials analyst, Nick Elliott, to discuss the new model. Nick, are you available?
Yeah, I'm here. Thanks. So this new standard doesn't go into effect until 2020, but this is the biggest accounting change for banks in decades. So bank management teams are going to begin discussing the impact this year. The basic idea behind the new standard is that instead of only reserving for losses that have already been incurred as required under current GAAP, banks are going to start reserving for expected losses over the entire life of loans on their book, with provisions taken upon origination. The basic impact here is that loan losses are going to be recognized earlier, as provisions are no longer going to require that probable threshold before they take reserve against them. And the other issue is that management teams are also going to be required to forecast the economic environment ahead to justify these reserves, which is going to leave open a lot of management discretion here. The biggest takeaway, though, is that the reserves are just generally speaking going to be a lot higher. The biggest change are going to be for banks with long-dated loans due to the life of loan concept. So if you have long-dated loans, that's 4 years that you have to provision for. And so look for mortgages and commercial real estate to see the biggest impact. From an earnings perspective, I would guess that the high-growth banks are likely to be affected the most due to the upfront provisioning. So if you're growing a lot of loans quickly, you're going to have to grow your provisions just as much. And then lastly, because reserves are not included in most capital, we expect a modest hit to capital ratios as well, with some expecting about a 75 to 100 basis point impact. However, this is going to be phased in over 3 years, so it's not going to be an immediate change. And now let me turn it back over to Zach.
Okay, so this is the time we had allotted for questions and answers. We already have a couple in the queue, so I will just turn directly to those. So the first question we got was, in the old lease accounting framework, a lot of effort went into structuring the lease so that it remained off balance sheet. Are there any areas in the new guidance where discretion will have a big impact on the numbers? This is probably best for Jen.
Yeah, this is a great question. Discretion will play an important role. One example is the lease term. It includes not only the non-cancelable period, but also some optional periods, such as renewal options that the lessee is reasonably certain to exercise. Determining what is reasonably certain requires judgment and can impact lease classification and how these expenses recognized, as well as the presentation of cash flows. Just to take a very simple case for illustrative purposes. Say we have a 1-year lease with an option to renew for another year. If the lessee determines that it is not reasonably certain to exercise the option to renew, then we have a short-term lease. In other words, the lease obligation does not have to be recognized on the balance sheet. But if the lessee decides it is reasonably certain to renew for another year, then we have a 2-year lease. And we will have to recognize a ROU asset and a lease liability on the balance sheet. Just generally speaking, all else equal, a longer lease term will increase the amount capitalized on the balance sheet, which also affects the amount recognized in the income statement. Another area where this question is involved is the lease payment structure. Under the new guidance, lease payments that are tied to performance, such as sales, are not capitalized. So if a lease is structured to have only variable payments determined by a percentage of sales, for example, now this may be an extreme case, then there won't be an ROU asset or lease liability. However, the downside of this payment structure is that all these payments will be operating cash outflows.
Thank you, Jen. So we have two related questions that I'm actually going to break into two. The first is, what are the main sectors or industries that are affected by the new accounting rules? And I'd perhaps focus the first part of that on the lease accounting and see if, Jen, if you have any thoughts on that.
Yeah, so if your focus is the balance sheet, then you have the, companies that have a lot of the companies that currently have a lot of operating leases, retailers, airlines, etc. But as I mentioned earlier, lessors are probably going to have some impact, especially in the area of sale-leaseback transactions and also leverage leases. So you're looking at some industrial companies and perhaps some financial companies in the leasing business.
Okay, and then related to that, and sort of the same question, but more specifically for Cecil, the question was, does this only affect banks, or should we look at other sectors as well?
I'd say that, well, obviously banks are going to be affected the most, but I think the biggest issue here are going to be the surprises, and that's going to come for companies that have financing as a secondary part of their business. So this is going to include your auto manufacturers with captive finance subsidiaries. Even there's a lot of retail companies out there that rely on financing programs such as installment plans. Even industrial companies, I think, are likely to be affected, especially if they have a lot of long-dated receivables or leases. For example, when IFRS 9 was introduced last year, which is a pretty similar standard, we saw an Australian construction company took a big charge against old receivables that had been sitting on the balance sheet. And the reason they weren't impaired before was because the losses weren't, quote, probable. And so all of a sudden this big charge came out of nowhere. So pretty much anybody that has any type of receivables is going to be affected.
Okay, we've got a few more questions in the queue, but I think we only have time for one more here. If we haven't addressed your call directly on the webinar, we'll get back to you individually, so I promise we'll do that. The last question we're going to get to is, in terms of the year two effect of the new revenue guidance, have you tried to quantify how material the risk of underperformance is?
I can take a stab at this, but feel free to jump in, Zach and Nick. Yes, we have done some analysis. In the industrial space, for example, there are companies that would have reported a negative revenue growth in 2018, excluding the benefit from ASC 606. But on an as-reported basis, these companies reported positive, in some cases, double-digit growth. This growth momentum may not be sustainable. The implication for earnings and margin growth is substantially more material in many cases. There are companies where the consensus, the Q1 19, is modest compared with the reported Q1 18. But if you adjust for the benefit from ASC 606, the consensus implies a much higher growth rate, which may be a challenge to meet.
Yeah, and I'd probably add one other thing, which has been a subject of discussion for our analysts internally, which is, and this seems very obvious to say, the more upfront companies have been about the benefit or detriment to both revenue and earnings from the change in accounting, the less market uncertainty exists, or the less likelihood that things are going to disappoint or surprise to the upside. What we found is that a number of companies have either just not disclosed that they received large benefits, or have mentioned that they existed but said they're just theoretical in nature or something like that. And when that's the case, the market has failed to assimilate that those gains, those incremental earnings benefits, are not going to repeat. Okay, so apologize that we have to cut the Q&A a little bit short. I want to get to a little bit of housekeeping and then let everyone get back to their work. As we wrap up today's session, I want to mention our next webinars. We'll hope you'll join us again next week on February 19th as I and my colleague Lindsay Bell discuss CFRA stars and model portfolio performance in 2018. including a review similarly of what worked and what needed improvement. That's for our equity coverage business more specifically. And then on February 28th, CFRA's head of Legal Edge Research, Nick Rodelli, will present a webinar on Qualcomm. Nick will discuss our views on the FTC versus Qualcomm case, including an assessment of the FTC's evidence, Qualcomm's defenses, and our thoughts on the Apple-Qualcomm licensing and litigation dispute and its possible impacts. Nick's work on Qualcomm over the last several years has been outstanding, and I think the reception to that has been highly positive, so I'd encourage people to join there. Links to register for both of these sessions will be sent to you this afternoon, along with a replay of today's session. And on a final note, on behalf of the team at CFRA, we'd like to thank you for joining us today. Within the next day or so, you'll receive a note from us with a link to the replay and slides. In the meantime, if you have any questions or additional questions we weren't able to get to, please don't hesitate to contact us at cservices@cfraresearch.com. Thank you for joining us.